after last week's triple header from the Bank of Japan, the US Federal Reserve and the Bank of England, interest rates will be centre stage in the coming week as well, although this time it will be from a bottom-up perspective. Some industries and companies and share prices are seen as more interest rate sensitive than others, and 3 of them are scheduled to report first half results in the coming week. They are the life insurer Legal & General on Wednesday the 7th of August, house builder Persimmon on the 8th, and real estate investment trust or REIT Derwent London also on Thursday the 8th. A company's business model may be seen as sensitive to interest rates for several reasons. Cheaper credit could boost the economy and demand for its products and services. Lower rates could reduce interest bills on debt and therefore boost profits. And cheaper borrowing could help a company invest in its competitive position. And lower interest rates can help share prices indirectly too. They may persuade investors to pay higher prices for stocks as they seek better returns than those on offer from cash or bonds. They may persuade investors to search for yield and look for stocks that offer juicy dividends. And they may lower the discount rate used in the discounted cash flow model or DCF and boost the theoretical value of long-term cash flows and thus asset and equity valuations. In the case of Legal & General, it could be argued that several of those apply, since lower rates could boost returns from and interest in its funds and savings products, and also shine a light on its forecast dividend yield, although some may assert that lower rates mean lower bond yields and lower returns on investment for a firm which needs those returns to meet its long-term liabilities, so it may not be win-win. Either way, June's strategic overhaul at Legal & General from new Chief Executive Officer Antonio Simoes did not fire investors' imaginations, even when he unveiled plans to streamline the business, sell its Cala house building unit, and focus on the corporate pension market. That all underpins his target to grow earnings by 6 to 9% a year up to 2027, and investors will look to the value of new pension deals, £13.7 billion in the whole of 2023, for signs and also for signs of progress in the USA in these first half results. They'll also look for growth in the dividend, where the FTSE 100 member is targeting a 5% increase in 2024, but a more modest 2% annual increment thereafter. In the case of Persimmon, the house builder shares traded a 12-month high, perhaps in expectation that interest rate cuts from the Bank of England will stoke demand for mortgages and thus new build properties, although hopes that the Labour government will ease planning restrictions and boost building volumes could also be a factor here. Analysts and shareholders will look to these first half results from Persimmon for signs of improved sales per outlet and an easing of input cost inflation. They will in turn shape volumes, where Persimmon has guided to a slight improvement between 10,000 and 10,500 completions this year, and profit margins, especially once pricing is taken into account. Persimmon's average selling price in 2023 was around £256,000. For the whole of this year, analysts are expecting a small increase in pre-tax profit and a flat dividend at 60p a share from Persimmon. The numbers here in the first half of 2023, by the way, as a benchmark, were pre-tax income of £151 million and an interim dividend per share of 20p. Finally, Derwent London has £1.3 billion in net debt, so lower rates could help here, at least over time, even if the company's loan-to-value ratio is fairly low by industry standards at 28%. Cheaper credit could, in theory, boost the economy and demand for its prime London properties. Watch out for the trend in vacancies and rental growth at Derwent London, as the share price suggests investors remain worried about working from home, hybrid working, and the relentless assault on brick-and-mortar retailers from online rivals when it comes to demand for commercial property. Lower rates also help the all-important net asset value per share calculation and focus investors' attention on the rental yield and the dividend yield from the stock. In the first half of a year ago, Derwent London's net asset value, or NAV per share, was £34.44, and that figure fell again in the second half to £31.29, but the shares still traded a big discount to that. For the whole year in 2024, analysts are looking for a dividend of 81.6p a share. That's up from 79.5p a share a year ago, and enough for a dividend yield of around 3.5% as we record this. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.